What's going on, my fellow wealth creators? Matty Guys here. In this video, we are going to have a lot of fun breaking down an interview that I watched on the Family First Life YouTube channel talking about IUL. And of course, there's a lot of inaccurate statements, a lot of misleading information about IUL in the interview that I want to address, because that is the biggest problem I have with index universal life insurance. It's not the IUL itself. Even though I'm not a fan, it's not a good fit for me. I could see where it could make sense for some people. Everybody's situation is different. My problem is the marketing, the illustration, the way it's illustrated, the way it's sold to people. I think most people who are putting their hard-earned money into these things don't know what they're actually getting involved with, don't know what they're putting their money into, don't know the risks involved, all the things that can change, all the things that can go wrong. And so you're not making an informed decision here. Making decisions based on how great the illustration looks, or all the benefits that you hear about, like you're going to hear some in this video. It's always the good side of the story, all the amazing benefits, but you never hear the other side of the story about all the things that can blow up in your face if you don't manage these things right, if you don't work with the right people. Because I almost bought one based on content like this, and I'm so glad I didn't. Because what I was actually looking for, come to find out, was dividend-paying whole life insurance. But here's the thing. Whether you do whole life insurance, you do IUL, you do neither, I don't really care. Just make informed decisions. And you can't do that without all the information, especially when you have inaccurate information about how these things work. So that's why I want to do this video. Let's go ahead and get into it. I'm going to have some fun. I'm going to speed this up a little bit just in the interest of time, and I'll just pause it as we go, and we'll have some fun.
Getting started right now.
Just getting started, dude. You were at what I say earlier, 500? No, 700 already through October, dude. That's awesome. And what percentage of that's IUL?
100%.
100%.
Yeah.
You don't do anything else?
Annuities, I probably do a little bit, not too much.
Okay. Well, good thing is we're going to talk about IULs today.
Right.
And
yeah, we'll see about that.
This is we're calling this piece here behind the policy, right?
Okay.
So, and I really want to give agents insight to basically how they can. The question here is going to help them get the IUL place, because that's a big piece, right? It's one thing to sit down and talk about the policy.
Yeah, so that's another thing, real quick, guys. This video is more for like agents within the company, like agent training, but there's still statements made about IUL that's going to be very beneficial from an educational standpoint that we're going to clarify.
Explain all the bells and whistles, get you interested,
right? Get
you to fill it out. But if that thing doesn't get approved, you're not covered. I don't get paid. We all lose, right? I love Andrew Taylor when he says that. He used to say that about the cashback options. Like there's three great things about this. One, if you buy it, I get paid, right? And then once you buy it, if you die, you get paid. And then if you don't die, you get your money back, so you get paid. So 3 ways we all get paid here. So my point is with the IUL,
I love it.
You love it, right? It's great. Yeah. But same thing there. The IUL, you sell it, you get paid.
Right.
The client's protected, and they're also earning money, savings, interest, or setting up their retirement. But what?
Yeah, that's the idea. So that's the first thing that I want to address is regarding the retirement. So here's the thing. Permanent life insurance can be a phenomenal asset in retirement. There's so many benefits to it. I'm going to do an entire separate training on how whole life insurance can maximize your retirement and even give you permission to spend more of your assets in retirement. So we'll talk about that. But here's the thing. The way that IUL is sold, like all the content that I've seen, and one of the things that excited me about it the most is it's positioned as if it's the primary source. It becomes the primary source of your retirement income, which it was never, ever meant to do. Permanent life insurance can be can provide really good supplemental retirement income, but the way that I see IUL illustrated is that it's the primary source, and it was never intended to do that. And there's a lot of risk that gets injected into the policy when you start taking those participating policy loans to create and generate that tax-free retirement income, but they don't talk about all the risk involved with that, right? It can be very, very dangerous, guys. You have to be so careful. And like when we're talking about retirement, it should be a supplement. It could be a supplemental retirement income stream. It's never meant to be the primary source of retirement income. And I'm not saying like that's how these particular gentlemen are positioning it, but that's how I usually see it sold. I even see agents talking about how 401ks are a scam and you should do IUL instead because you're going to get so much more retirement income. On paper, it looks like you might, but what happens in reality? That's a totally different story. And there's not like, this is also, guys, this is a financial experiment with IUL. Like there aren't even I don't know anybody. I've never seen an in-force illustration of somebody that's actually successfully taken retirement income from an IUL policy for an extended period of time. I don't know that exists. Maybe it does. I'm sure there's some people out there, but there's not a big enough sample size to really determine whether or not this works for like getting all that retirement income. So please be really, really careful with that. All right, let's continue.
What are some common reasons, Juan, that you see an IUL being declined for?
Mainly, a couple of things that can deny people is the health, which is one of the. And so an IUL will be if you qualify for a term life. So anybody that sells like term life, if they qualify for a term life, they should qualify for an IUL health wise.
Right.
And then the other one is some carriers they pay a lot of attention on like DUIs in the last 5 years, not after 5 years, but more in the last 5 years. That can disqualify, or anything criminal, or a bankruptcy can also. So a lot of people ask me, hey, what about my credit?
Yeah, and this stuff is pretty standard across the board when it comes to underwriting, regardless of the type of policy that you're getting. When it comes to underwriting, obviously the primary factor is going to be health, age, things like that. But some companies put a little bit more weight on background checks and credit and stuff like that. But usually those aren't a big deal.
My credit is not that important,
right?
But if they have like bankruptcy or something real big, it can disqualify them.
Got it. So if you're a brand new agent or you've sold some mortgage, you're kind of going the mindset is if they were healthy enough for a term, they'd be healthy enough for an IUL.
Exactly.
You're not taking your final expense clients and putting them in an IUL. It's not going to work because of the underwriting.
Right.
And of that $700K that you've sold this year, how much of that are simplified IULs?
Okay.
They're very. I go through what I call.
So before he provides his answer, I want to talk about simplified issue. Okay, this is really important, guys, especially if you're considering getting an IUL from one of these multi-level marketing financial services companies, which that's a whole other video. I'm not sure that I would really recommend that. Not saying they're all bad, but that's a separate conversation. Here's the thing, simplified issue. He's also going to call it by a different term, instant approval, right? So simplified issue means that you're not going through the entire traditional underwriting process that you normally would, like, doing a, medical exam, providing blood and urine samples and things like that, where that can take weeks, sometimes a couple of months. Everybody's a little bit different. Right. It's usually, it's a pretty long process. But what the life insurance company is doing when it comes to underwriting is they are assessing risk, and then they're going to charge accordingly based off of their due diligence and whatever risk classification they give you. All right. So they charge accordingly. These are they're really, really good at doing that. That's why they survived for so long and been profitable for so long. They're the best risk management companies in the world because everything's based on actuarial science. Now, when you take all that away, and you come up with something like simplified issue, instant approval, where you're approved in 10, 15 minutes, and you're not going through the entire underwriting process, what does that mean? The life insurance company is taking more risk. So if they're taking more risk, what do you think they're going to do? They're going to charge more for the additional risk that they're taking. So oftentimes with simplified issue policies, instant approval policies, they're a lot more expensive than what you would get for the same type of policy if you went through the entire underwriting process. So if you're younger, healthy, you want to go through the underwriting process so that you can get the best policy possible, right? Because again, it takes a few weeks, a couple of months. So what? This is a long-term major financial decision that we're talking about. Like, we want to make sure that we're doing this right, in my opinion. Now, here's the thing. Are there some use cases for simplified issue? Absolutely, 100%. But I seriously doubt that, I think the majority of the business that a lot of IUL agents do within these types of companies is that simplified issue. Here's why. The agent gets paid faster. Like the major, really the only person typically that benefits from a simplified issue policy is the agent because they get paid faster. Okay. Now, like I said, in some cases, can it benefit the policyholder? It depends on, health and things like that. You, like if you were to get approved, for example, for a substandard rating, if you went through the entire underwriting process, but then you went through to get a policy through simplified issue, that simplified issue policy might actually be a little bit better than your substandard policy when you went through the entire underwriting process. But you have to do both to really find that out. So if you get a substandard rating, it could be worth it to look into maybe getting a simplified issue instant approval policy just to see the difference in the numbers. But if someone is putting everybody into simplified issue, that is just to get paid faster 9 times out of 10. So the major benefit of that is so the agent gets paid faster, guys, most of the time, not every single time, but just be aware of what you're getting involved with. If you're doing simplified issue, you could likely get a much better policy if you went through the full underwriting process. So keep that in mind.
Most of them are going to be instant approval.
Instant approval.
So they're about 70% of my policies get instant approval.
Yeah.
Because I qualify people, I ask them the questions.
Yeah.
And one of the good things is if somebody's doing it for a savings purpose, like if a 60-year-old person comes in and then they want to do it for a savings purpose and they don't qualify, I tell them, I say, hey, what about putting it into a 20-year-old or 25-year-old body for you? And then what I'm talking about is their son or their daughter, because I already found out how old was the daughter and they're in good health.
Got it.
So, yeah, and what he's talking about here is a pretty standard strategy. Like if you want to get a policy for supplemental retirement income, get the benefits of accessing cash value and stuff like that, but you don't qualify for a policy based on usually health, then you could get a policy on a loved one. And you would own the policy, they would be the insured. So if they passed away, then the death benefit would be paid out, usually to yourself or other beneficiaries. But you own the policy, so you can still access the cash value, and you're in control of that. So that's a pretty common strategy among, within the life insurance industry.
So I'll do an IUL for the son or daughter that carries his money.
Okay, so all right, let's play that out. I'm 50. Right? I know I don't look 51, but I'm 50 today. I got some health issues, but my daughter's 20. She's in great shape, but I want to save some. And this is for retirement, right? So you would tell me what?
I would say, hey, Mike, looks like we will have a little bit of trouble because of the health that you have. But the good thing is I can put you in the 20-year-old body right now.
Good.
And what we're gonna use is your daughter's body to carry that tax-free growth of your money.
Got it.
And then it's gonna be actually a lot cheaper. So that would be more savings for you. You'll have access to that money whenever you need it.
It is cheaper too when you do that because you're doing it on a younger, healthier person. So obviously the costs are going to reflect that in the policy.
Now, and then my daughter has a policy now.
Right.
But I'm putting this money in for me to fund.
And you're managing the money.
Yeah, I'm managing it. Yeah, that's awesome, dude. That's a great point. So, but going back to earlier, well, first of all, the simplified IUL is the way to go.
Right.
No.
Like I've heard this from people like, I was telling this guy, he's like, my numbers are real down. Like, why? Well, we wrote a bunch of IULs. We're waiting for them to pop. I'm like, what does that mean? What do you mean waiting for them to pop? Like, you just write them and they get approved or not. No. Well, you come to find out you're writing a bunch of fully underwritten stuff.
Right.
Which,
God forbid we do that. God forbid it takes a little bit longer for our policies to go through and get paid. Like, guys, we're not. I mean, obviously, like I got nothing against making money. I want everybody to make money, but do it in an ethical way where you're actually doing what's best for the client. If it comes to be that the client would have benefited so much more by going through underwriting than doing a simplified issue, then so be it. Like if you would rather if you know that they would get a better policy going through full underwriting, but you're still going to do simplified issue so you get paid faster for your business and you make money faster, you're in my opinion, you are in the wrong business. That the most important thing in this business is to do right by the client, whatever is going to be best for the client, not us as the agent. Like, for example, another example of that is when I help people set up whole life policies. I do not do IUL, but when we set up a whole life policy, I significantly reduce my commission by setting up the policy for high cash value. All right. So I take a major pay cut, and I'm actually working with somebody right now. It's so frustrating because he already has a policy that was it was not set up correctly at all. It was set up for maximum commission for the agent. Agent had no idea what they were doing, or if they did, maybe they just didn't care. I don't know. But it was 100% base premium policy, maximum commission to the agent. The client's not going to break even until like year 14. And now the question is coming up, well, do I cancel this? Do I not? So, do I take the $50,000 hits? It's so frustrating because so many agents are so focused on how much money they're going to make or how fast they get paid. Guys, that's not what this is about at all. That's just, so when he says the way to go is simplified issue, no, it's not. It could be, but how do you know unless unless the person has already gone through full underwriting? We know they're going to get the substandard policy. Let's try the simplified issue, see if we can get better. But if not, then we go through the fully underwritten policy. But you don't know that if you're just putting everybody in simplified issue. That's so frustrating.
And this is what people don't understand is, yeah, the price you show may look better, but what happens 90% of the time when I'm showing you a ultra preferred rate, right? And you're going, oh, it's $5 a month, and then I put all this money in, then it comes back at a subpar, substandard rate. What does the client say then?
They don't want it.
They don't want it.
That's not true at all. And that's not even an excuse or a reason to put everybody in simplified issue just because they might come back at a substandard rating and the numbers don't look as good. Your job as the agent is to manage those expectations up front. Don't illustrate the best case possible scenario. How about we under promise and over deliver here? Let's illustrate at a standard rating, not ultra preferred like he just said, which shows the best case scenario. Let's do a standard rating illustration. Okay, here's what the numbers could look like. We might get a substandard rating based off what you've told me regarding your health. Something could come up, so these numbers might not look as good. We just have to wait and see what underwriting comes back with. But also, if you're just selling based on the illustration, then you're not doing it right anyways. Because even if they get a substandard rating, these policies, not IUL, but in my opinion, whole life, even if they got a substandard rating, it still provides so many benefits. Yeah, it might not be as efficient. The numbers might not look as good long term, but it still provides an immense amount of value to somebody's life. And that comes down to how the agent educates people, how you're positioning this policy. If it's just about the numbers, in my opinion, you're not doing it right. So, but the main part of that is just because it comes back substandard, oh, most people don't want it. Well, that's not always the agent's fault, but you're positioning it incorrect, and that's not an excuse to put everybody in simplified issue.
Yeah.
Instead of me going, hey, I can get you the simplified one at this rate. Yeah, it's not the ultra preferred, but it's definitely not that substandard. But there's no guesswork.
But what if you could get ultra preferred? Now your policy is going to do even better.
No waiting for months. Like, and I'm sure you've written some of these for you.
Yeah, God forbid we have to wait a couple of months to solidify a very long-term financial decision.
Written ones, right?
I do the ones that are basically, it can be simplified. So I do a lot of NLG. So okay. Like NLG is a fully underwritten, supposed to be, but they're simplified.
Right.
So they don't go.
Now, real quick on that too, guys. I just did a video about on this. This is not like financial legal advice on whether to work with a company like NLG or not, National Life Group. Just so you know, NLG is in a massive class action lawsuit right now because of the misleading nature of a particular IUL product. Not saying this gentleman is selling that. Not saying he's utilizing these, because the issue with the lawsuit is the volatility control indexes and the extremely misleading nature of them and the way they're illustrated. But I think that's an important piece of information. You should know that if you're buying an IUL, that the company is involved in a massive class action lawsuit. Let's find out what that is. It doesn't mean that you don't work with that company, because I mean, companies can get sued for anything these days, and sometimes it's stupid. Like there's no merit to the lawsuit at all. And I don't know what's going to happen with the lawsuit, but I do want you to be aware of that. I just did a video with a friend of mine breaking down the entire document. If you want to check that out, I'll have that down in the description. Just want you to be aware of that.
Well, so medical only for 65-year-old or older, or somebody takes a lot of medications.
Right. Got it. And that's a good point too. There are some that are technically underwritten, but they're non-medical.
Right.
So it's very similar to a simplified. Underwriting is a little different, but you're not doing blood. Because once you do that, I mean, on average, how long do those take to get issued?
30 days or 45 days.
If you're lucky, right?
Yeah, exactly. Sometimes it takes longer than that.
Yeah. And it all depends on the client's health, but I've seen some take 3-6 months.
Yeah, I'm still waiting for 2 months ago.
Yeah.
And there's another one.
And if it does, so be it. It is what it is. If it's going to be better for the client, then that's what you have to do.
It's 8 months now.
I believe it.
It's like,
but the key is you do that when you need to. But like you said earlier, would you say 80% of your?
Yeah, 70% of the people get instant approval.
Yeah,
they get it because National Group does instant approval.
Mm-hmm.
I think FNG started to do instant approval recently, so it's kind of like that.
Yeah,
real quick.
Got it. We're gonna move on to objections. So this is a topic that if you ask me, You ever see those posts on TikTok? If you ask me about objections, I say this. But if you ask me on a deeper level, if you ask me about objections, I say you should remove them and avoid them up front, right?
100%. That's what I was going to tell you.
Yes. But if you ask me on a deeper level one, there are some that may still come up. And these are, well, I'm going to kind of throw some at you and you just play, hey, I'm the client. You're the agent. Tell me what you would say to this. So you're pitching me the IUL, right? And I go on, I can make more money in my 401k than that IUL.
Sure.
Yeah.
And then, so why here? Why you're here right now? And then it says, I'm sure.
Well, actually, you know what? I'll let him give his answer, and then we're going to talk about the 401k IUL argument.
As I show you, remember when I was showing you the chart of the red line when it goes up and down?
Yeah.
What happened if something happens in the 2001 or 2008?
Right.
Will you be happy with that?
No.
Okay, so let's talk about this for a minute. So IUL agents love to attack the 401k. I've even seen, like I said earlier, agents say that 401ks are a scam. You should move your money, like stop contributing to your 401k, even move money from the 401k, put it into the IUL. Now, here's the thing. In some situations, could that make sense? Probably not, but I'm sure there's somebody out there that could benefit from a situation from like that. But I seriously doubt that it would actually be beneficial for somebody to withdraw from the 401k to put this into an put their money into an IUL. Yeah, not gonna happen. But not a good idea. But the primary argument for this is that upside potential, downside protection in the market, right? So you have that 0% guaranteed floor with IUL. So they claim that you can't lose money, which they're actually going to say in this interview. He's going to say that you can't lose money in an IUL, which is not true at all. It's a straight up lie. And because here's what happens. You don't lose money in the market, but you can lose money because of the market. If you have a 0 year, there's still cost of insurance. There's other fees involved with the IUL. God forbid you're taking participating loans for retirement income. Where do you think that 5% interest is going to come from during a 0 year? And especially if you're not even making premium payments anymore. It comes from your cash value, guys. So you will lose money in an IUL whenever you do have a 0 year. It gets worse as you get older and you start taking policy loans for income. Like that just injects so much risk. So it's very misleading. And like, yeah, like he was talking about like the .com crash, the 2008 crash. Would you want to go through that? I mean, obviously nobody wants to go through that, but here's the thing is that's one of the things I was alluding to earlier with how permanent life insurance can provide, can be a really, really powerful asset in retirement, because when that does happen, then you can tap into your life insurance policy for your income. Like I said, it can be really good supplemental retirement income. It's also a fantastic volatility buffer, which is what I'm talking about right now. So when the market does go down, instead of selling your assets inside of your 401k for your income during a down year, which is going to compound the loss and put the longevity of your portfolio, it's going to significantly reduce the longevity of your portfolio if you do that. But while the market's going down, instead of taking income from your 401k, you would take it from your life insurance policy, wait for the market to recover, and then you can resume taking income from your 401k. Pretty simple. That's not complicated. And that right there will significantly increase the longevity of your portfolio. Okay. So it can be a really good volatility buffer. But when they're talking about getting so much more income and also the tax advantages, like because it can come out tax free in the form of policy loans. While that's true, it's kind of a half truth, because when it comes to the illustration, because it's so misleading, it shows the market going up every single year. It shows credit every single year. It doesn't show any 0 years. And when you have that massive loan balance because you've been taking income, where does that interest come from, guys? And so the fact that the market can go down, your portfolio can go down in your 401k, again, is not a reason to not contribute to a 401k or and that you should move all your money into an IUL. It doesn't mean that an IUL is better. Like I said, an IUL is a massive financial experiment right now with a terrible track record so far. It's not looking good whatsoever. All right. So if you want to roll the dice with your financial future on the hopes and dreams of this financial experiment, then be my guest, but make sure you know what you're getting involved with, because sure, there's volatility in the market. And here's the thing, I'm not a fan of 401ks. It's just not a good fit for me, but not doing your 401k and doing an IUL instead, because you can get upside potential, downside protection. There's a lot more under the surface that you need to understand before you make that major financial move. So yeah, fun stuff.
No one's going to say yes.
And you mentioned that you like green line that I show you better than that. That's where you wanted to keep your money.
Yeah.
Why was that reason that you wanted to keep that money there?
Right. Keep it safe.
Because you wanted to be not losing any money when the market goes down. And then that's the reason I feel like, yeah, you may be able to do better, but in the long run, I don't think you're going to be beneficial.
Right.
And
how do you know? How do you know that? It's like the IUL is just sold on this illustration, like the best case scenario. But how often does the best case scenario happen in life? I mean, I guess sometimes it does, but you know, like I said, this whole thing is a financial experiment, and you know, there's a lot more risk to these things than just volatility in the market, because there's ways to handle that. You can manage things in an IUL, but once you get older and you have that massive loan balance, man, it gets tough. All right, let's continue.
And then if you catch it on the downside, you're gonna be like, I wish I would have went with one.
Correct.
You know.
Yep, that's huge. Now it is in a way.
Yeah, when your IUL blows up in your face at 70, 75 years old, you're gonna wish you didn't do it.
Doing things in the beginning to avoid this, or when it does come up, you already have the ammo, right? Because you've shown them this chart, where it shows how the IULs don't lose money. So you've done that beforehand. So if
right there, oh my gosh, I can't stand that. IULs don't lose money. Are you serious? How is that even legal? How does that get past compliance? You will lose money in an IUL when you have a 0 year, because there's still costs involved with the policy. It has to come from somewhere. If you're not making premium payments, it comes from the cash value. So you will lose money. And then when you start taking policy loans, they're usually what's illustrated are these participating indexed policy loans, so that your cash value continues to get that interest credit. But here's the problem is when you have a 0 year and you have a $300,000 loan balance because you've been taking $50,000 per year, like the illustration told you could, well, where does that interest come from? It comes from the cash value. You will lose money in an IUL during those 0 years. So, man, it's just such a misleading statement. I can't stand when people say that.
If they go to bring this up, you go, do you remember what we said earlier?
Mm-hmm. And I asked them, I showed them, and I asked them, say, hey, when I show you those, where would you like to keep your money?
Yeah.
The red line, the blue line, or the green line? And they all say the green line.
Yeah.
The green line says, which is the IUL line or the annuity line.
Right.
And then I say, okay, sounds good. Let's help you get there. Let's see if we can help you get there.
And that's a huge point. It's like I almost hesitate to even call it overcoming objections, because if you don't plant that seed early on, like if you never show them that chart and I say that, now you're backtracking.
Right.
And then they're probably thinking, well, why didn't you say that in the first place?
Right.
But you have to plant those seeds. So here's a couple more. I've heard IULs have very high fees compared to other financial options.
The main cost is the insurance.
Okay.
And there's not really like a real cost to it. It's more the benefit. Because if you die, you pay $300 and somebody gets, 100,000, that's a big benefit.
Yeah.
Which if you put it in the bank, if you die 20 days later, how much is your family going to get?
Right.
$300.
The bank will figure out some way to take your money.
Yeah. So here's the thing. There can be a lot of fees involved with an IUL. Everyone is different. Here's the thing is I don't really have a problem actually with fees and commissions and things like that. Like fees and cost, like if we're getting so much more value, like it comes down, we need to ask ourselves, what's the value? What's the benefit I'm getting for the costs and fees that I'm paying? If it far exceeds those costs and fees, then it's worth it. So the fees are just kind of relative, but the question is, are you getting enough value and benefit from the cost and fees that you're paying? Maybe not. That's why you have to do your research on these things. Is the risk I'm taking as well worth the potential reward? That's another way to phrase it. Fees, obviously we want to pay as little fees and lower our expenses as much as we can, pay as little fees as possible. But the fees is not really the deal breaker, or shouldn't be the deal breaker necessarily. But that's why also too, I think it's important to shop around. Like if you are going to get an IUL, make sure you're working with somebody that can shop around for you and not just stick you in one IUL because it gives them the most commission and it pays them the fastest. So, make sure you look at a couple of different companies, a couple of different policies for that.
So there's a huge benefit.
Yeah.
Also, one thing I do want to point out, he's talking about the cost of insurance being the primary fee. Like it's not a big deal. It absolutely is a big deal, because your cost of insurance, that's a major fee in an IUL, especially when you get older, because it's built on annual renewable term. Think of it as a 1 year term policy that renews every single year. Well, what happens Like when your 30-year term policy expires at 65, most people cancel it. Why? Because the cost skyrockets. Where you were paying maybe $1,000 a year, you might be paying $20,000 a year at 65, 70, whatever. Right. So term gets very, very expensive as you get older. So that's what this thing is built on. And if you don't manage your net amount of risk, if the policy doesn't perform like it was illustrated, you could run into a lot of problems with cost of insurance, guys. Your cost of insurance goes up every single year exponentially when you get older. Something to be aware of.
I don't feel like IULs have a fee.
Right.
They have benefits.
Got it. I love that. And
right, but those benefits have costs. There's fees for those benefits. So again, it's the downplaying of these costs that I'm not a fan of.
I mean, you're very clear that we're here for life insurance. Right. Yes, it has a safe, but it is a life insurance policy. There's no one's confused about that.
Right.
If you're selling it any other way, you're doing it the wrong way. Like you need to let them know this is a life insurance policy. Right. There is a death benefit. Now we can do things like you said this on your Truth Talk. You can design them, right? So if you know I'm all about the savings and the retirement, and I go, wow, listen, I got term policies already. I don't really need the insurance. What would you do from a design standpoint?
I typically will design it the way that is if somebody is wanting for growth, then I design a minimum death benefit with the maximum cash value.
Yep.
And I always tell them, I says, you're gonna hear this is another objection that I overcome is that you're gonna hear on social media bad things about IULs.
Sure.
And I'm sure there's a lot of IULs that are bad, but they're not the IULs that are bad. Is the design that was done wrong. And says.
Okay, so let's talk about the design. Hopefully he is at least designing them properly, but here's the thing. It doesn't really matter if the policyholder does not fund it properly. And, actually one other thing on the design before we go into the funding part is, I hear IUL agents say this all the time. Oh, it wasn't designed properly. It seems like every IUL agent knows how to design a policy, but I've never seen a properly designed policy, ever. And so if all these agents know how to design a policy, why are there so many lawsuits? Why are there so many people getting hurt by this thing? Why are so many policies underperforming? Even if they are designed correctly, they can still underperform. But like you still have, even though it's designed, it can be designed properly, you still have to fund it correctly as well. One of the benefits of an IUL, because it's universal life insurance, you have that flexibility of like moving your premium around, adjusting death benefit and stuff, and that's promoted as a benefit. But if you don't fund this thing correctly, it can absolutely blow up in your face and not do anything close to what was illustrated. So it does need to be designed. Like if you are going to do it, you need to make sure you work with somebody that knows how to design them, because that is important. But that's not the end all be all. That's not going to, that doesn't fix all the problems with IUL. It makes it increases the chances of success for sure, but there's still a lot of things that could be changed. Like even if you design it correctly, what happens when the company lowers the cap rate or participation rate, changes the spread rates and charges or whatever? What good is your design at that point? Like the design you created and the illustration you showed based on your design has just gone completely out the window at that point, because like all the things that the life insurance company is going to change in order to manage their risk as interest rates change, as the cost of call options changes, because that's how an IUL earns interest credit, guys. It's a call option strategy. So there's a cost to those call options. There's an options budget that needs to be generated, right? All those factors can impact the long-term performance of the policy when the company needs to make changes to your policy to manage their risk. What happens to the design at that point? Not good, that's for sure. And when I say that, meaning like if it was designed based on, let's say, a 12% cap, a 10% cap, whatever, but a few years later, your cap is now 7%, 8%, 9%, like what does that do to the long-term performance of the policy, even though you designed it correctly? That can have and does have a very negative impact on the policy.
Now, let me ask you this. If you were building a house, will you choose an architect that just got out of it and they have no idea exactly how to design a house, and this is the first house that they did, or will you choose somebody that is known for building homes and is an architect?
Right. No one's going to pick the first one.
Yeah.
So what's funny about that analogy is that with MLM financial services companies, that's a lot of the times what's happening. Like they recruit people into their organization. They have no training around the product. They bring their upline in to sell it, but their upline doesn't usually have a ton of experience setting these things up. Like, we see the worst designs, the worst policy designs coming from these MLM financial services companies. So like this analogy, while there's some credence to it, like a lot of the times these MLM companies are doing the exact opposite, and he's part of an MLM style company. So it's just ironic.
So I say the reason you're with me is because I'm going to design it the right way. I know. Okay.
Also, the other thing, using his analogy, using the architect analogy. So you want somebody with experience, but what if you have somebody with experience, but within that, within the contract you have with that architect, they can change that design without your approval throughout the life of building your house or designing your house. Like, let's say it takes 10 years, right, to put together. And by year 10, it's like the total, like, it doesn't even look anywhere close to the original design because they change it so much. That's what can happen in an IUL, guys, because the life insurance company can change so many different things in the contract regarding the performance of the policy, cap rate, participation rate, spread charges, everything, right? So you might have a great design, but it could be totally different. Like the end result could be totally different because they were able to change so many different things. So would you work with an architect that can change everything without your approval? I wouldn't.
So this is the way that we're going to design. So we're not going to design. A lot of people come with bad IULs that I have to redesign correctly. And then so I show them the difference between a focus protection and a maximum fund IUL. And then when they see that, they know that they got the right architect.
Right.
And for those of you who are new, you become an architect just by listening to me.
Absolutely.
Right now. It's like, you know, that basically you already know how to design IUL, but there's more than 90% of the agents out there that have no idea, or State Farm doesn't know how to design an IUL. No. So that's just because they got the license doesn't mean they know how to design it.
Right. Absolutely.
That is true.
I also think that a lot of times the objections that you get are things that people just heard on social media. They read somewhere. Somebody said, I mean, remember Susie Orman used to trash annuities, right? And I remember like you go into an appointment and bring up annuity. Well, Susie Orman says they're bad. Like, oh, okay, all right. Is she here? Like, does she pay your bills? She's talking about variable annuities. We're doing fixed income. But
so I do agree with him on this, that, you know, there's a lot of really bad information on social media. And here's the thing. I even tell people, don't take what I'm saying at face value. Like, what he's talking about is something I talk about all the time. Just referencing how important it is to do your own research. Like, we can get ideas about things that we want to look into from social media, but we shouldn't be making, in my opinion, major financial decisions based on stuff we hear on social media. We need to do our own research and actually understand how these things work, hear both sides of the story before making a decision. So I do agree with that.
Same thing. A lot of the stuff you hear, it's just people just throwing out shit that they heard or read. Like, here's one. I've heard the cost of insurance gets higher every year and will eventually eat up my cash value.
Fiction.
So oh my God, dude.
That's what I tell people. I says
fiction, really? So you see how they downplay all the risks involved with these policies? Like, are you kidding me? Fiction? That's not fiction. That can absolutely be true. Now, here's the thing. So cost of insurance goes up every single year. Your net amount at risk can be managed, because net amount at risk is death benefit minus cash value. That is the number your cost of insurance is applied to. You can manage that, hopefully through policy performance, like your policy actually performs, and you set it up right to where you have a small amount of net amount at risk, and you can adjust death benefit and all that stuff. But to downplay the problems that cost of insurance can cause, this is so frustrating, because I've seen plenty of stories which result in lawsuits. I've seen this on Reddit as well. Like, I have a subreddit that I follow about life insurance, and it's just really sad when these people receive these massive bills from the life insurance company when they thought their universal life policy was paid off. And I got news for you guys. The index universal life insurance policy, the IUL, is not that much different from a traditional universal life policy. It's literally the same thing. The only thing that changed was the interest crediting strategy. That's it. They're using indexing instead of like directly with interest rates on a traditional UL. And these poor people, when they hit retirement, 70, 80, 90 years old, They thought their policy was paid off because they're not making premium payments anymore. He's going to bring that up in a second here, and we'll address that. But they think it's paid off. It's not, because it's built on annual renewable term. The cost of insurance is skyrocketing. And if your policy does not perform as illustrated, you can run in your net. You're not managing your net amount at risk. That cost of insurance will eat up all of, maybe not all of your cash value, but a lot of it. It can become a massive problem when you get older. So him calling it fiction, and it's not a big deal. It's so misleading, guys. You got to be really careful with that.
Now that we got a competitor that sells basically term invest the difference.
Mm-hmm. Yep.
So when I run into that, I love it. I love it because I can beat them every time.
Yeah.
So if I take term and invest the difference versus an IUL, then IUL is both. But the best thing is if you're doing a term invest the difference, your term is going to expire 30 years later, per se, and you're going to have the investment per se. But now you don't have a life insurance. Now, if you do an IUL after 10 years.
That is true. I can agree with that. But see, here's the thing. I mean, I'm not a big fan of buy term and invest the difference, but can it be right for some people? I suppose. I do agree. Like when your 30-year term policy expires, you no longer have life insurance. I do think a lot of the times that can be a mistake. That's just my opinion and just how I think about finances. But yeah.
Years of max funding the IUL. You actually have an IUL that is paid for the rest of your life. So that means you already got a life insurance permanent plus.
Guys, oh my God. So this is where he's talking about the IUL being paid off. Let me see if he says anything else.
You have the tax-free growth of the money. So if you continue, that means you already got a life.
I need to hear it again because I just cannot believe he's actually saying that.
Rest of your life. So that means you're. But now you don't have a life insurance. Now, if you do an IUL after 10 years of max funding the IUL, you actually have an IUL that is paid for the rest of your life.
Oh my God. I cannot believe this is legal. This is unbelievable, guys. That is a straight up lie. Do not believe any agent telling you that you can pay off an IUL. You can stop making premium payments. Okay, it's called vanishing premiums. When you look at the IUL illustration, he's talking about max funding for 10 years. So you pay into it for 10 years, and then you see zeros after that on the premium payment column. That does not mean it's paid off. That just means you stopped putting money into it. That is it. But there is cost of insurance due on that IUL every single year for the rest of your life because it's annual renewable term. Now, I don't know, maybe there are some IULs out there that have a rider or something where you can pay it off. That's going to come with a pretty significant cost if that does exist. Most IULs that I'm aware of right now don't have anything like that. So the fact that it's built on annual renewable term means you cannot pay it off. That bill is due every single year. All right. You can pay off a whole life insurance policy just like you would pay off a mortgage on your home. You can do that with a whole life policy, never have to make another premium payment ever again. It's going to continue to grow and you will never get another bill from the life insurance company ever again. That's with a whole life policy. With an IUL, that is not true at all. That is like one of the most misleading statements I think other than you can't lose money in an IUL, that's probably the second most misleading statement I've ever heard an IUL agent ever say is that your IUL is paid off. Such a lie. It's incredible that this is allowed.
So that means you already got a life insurance permanent, plus you have the tax-free.
It's only permanent as long as you have cash value, and that cash value can cover the cost of insurance and other expenses and fees. As soon as it can't do that, and you get a bill when you're 80 years old, 85, whatever, saying, hey, you owe thousands of dollars because you have no more cash value left, and you can't make that premium payment, poof, it's gone. There's nothing permanent about a policy that can blow up in your face and lapse or that you have to get rid of. Not to mention the massive, you would also have a massive tax consequence potentially to that as well. And it's just, this is a risk you have to at least acknowledge. I'm not saying that every IUL is going to blow up and that, because that's kind of the worst case scenario. But can it happen? Does it happen? Yes. It can absolutely happen, and you need to be aware of it so that you know how to avoid that situation and decide whether that's a risk you want to take or not. But when he's saying that you can pay it off and you don't have to worry about that, whoo, man, now we're making decisions based on inaccurate information, and that's where people get hurt.
Growth of the money. So if you continue, you actually have both.
Right.
So there's no, I mean, which one would you rather have?
Yeah.
Both or the ones that expires 30 years later.
Right.
And that's how I close.
Gotcha. Now, the idea of the cost of insurance, it does increase with IULs, but if they're set up the right way, it's never going to be an issue.
And max funded?
Never going to be an issue. That's just not true.
IULs is not an issue because it takes care of itself 10 years later, or you can do it. You can do it even 5 years. If you max fund totally like to a neck, then you're doing 5 years or less.
Right. And that's, I mean, just what I said earlier, they're just throwing out things that maybe they read somewhere, half paid attention to, and they're just trying to mess with you.
Right.
You know, and going back to what you said earlier about being the architect, the design, if it's designed right, none of these things apply anyways.
That is so not true, because you still have to fund it properly. If you fund it properly, the risk of these things are decreased. Absolutely. But a lot of times that's not the case. People don't even know how to manage these things. And there's so many people are getting hurt by them.
We're gonna wrap with this. A few scenarios I'm gonna throw at you where, and really the goal here is like for brand new agents, it's hard.
I think I'm gonna go ahead and wrap up. This video is long enough. Maybe I'll do a part 2. I'll link to this video down below if you guys want to watch the entire interview. If you want me to do a part 2, drop a comment down below. Let me know. Those were the main things though that I had an issue with, because like these things do matter. Like when they're downplaying the risks of cost of insurance, like, oh, none of these things are going to matter anyways. It's not you design it properly, you max fund it, it's not going to be an issue. And it's not going to be an issue in all policies, like people who know what they're doing and they actually max fund them. The other problem though is performance of the policy. Do we really know what these things are going to do? I mean, some of them I'm sure do okay. But you know, we've been in the longest bull run in history. So why are so many IUL policies underperforming? Like, you know, and the reason is because there's a significantly less correlation between the stock market, the S&P 500, and the performance of an IUL than what is presented, because you're not actually invested in the market. You're not getting dividends. You're buying call options, which cost money. There's a call options budget. The life insurance company can change all the performance factors inside of the policy. Like, it's a gamble, in my opinion. Like, you don't know what's going to happen. Every single year, something could change. You don't know what's going to happen. So how can you make a long-term financial decision based on that, on this type of product? I just don't see it. All right. So like I said, it can be right for some people, but man, you really got to know what you're doing with these things. These are very complicated products. It's not as simple as they're making it out to be. And I just want you guys to be careful. Make sure you know how this works. Make sure you're working with the right person. If you want an introduction to people that I've seen do IUL correctly, I'm happy to do that for you. Drop a comment down below and I'll set that up for you. But anyways, just please be careful out there, guys. I hope this was helpful. I wish you all the success, and I will talk to you in the next one. To your success, Matty Ice is out.